Fannie Mae specifically allows lenders to skip the 2-year income average for self-employed borrowers when a documented hardship caused the low year. Most loan officers never read that section. You are probably watching this because you rebuilt your life through self-employment after a layoff, and a lender used your hardest years against you. I had a client named Jerry, a former corporate manager from Charlotte, who was laid off in a company restructuring, built a consulting business, and got told no by a lender who ran a 2-year average and stopped. Like Jerry, you were told the income is too inconsistent. That lender was wrong, and I can prove it. Stay to the end and I will give you the exact sentence to say to your lender that forces them to apply the correct guideline to your file. Here is what the guidelines say. The rules define extenuating circumstances as non-recurring events beyond the borrower's control that result in a sudden, significant, and prolonged reduction in income. A corporate layoff fits that definition exactly. The guidelines are also clear on this. When the most recent year of self-employment income is significantly higher than the prior year and the increase is documentable, lenders may use a single year of income rather than the 2-year average. Combine those two provisions and you have a documented case that says the low year was a hardship event, not a pattern. Now here is what most borrowers do not know. Individual lenders add their own rules on top of the government guidelines. Those extra rules are called overlays. A lender's overlay is not a government requirement. If a lender cannot show you the specific guideline section that prohibits your approval, the decline may be an overlay, not a rule. For Jerry, I pulled the layoff documentation, the CPA prepared profit and loss, and the signed client contracts. I submitted to an investor whose overlay policy allowed single-year income analysis with documented hardship. Underwriting approved, Jerry refinanced and his payment dropped. I read the actual government manuals, so I know which investors allow what the guidelines permit. Here is what I promised you. Go to your lender and say this exact sentence. My income reduction was caused by an involuntary corporate layoff, which qualifies as an extenuating circumstance. I am requesting that you evaluate my current year self-employment income under the single-year analysis option with documented extenuating circumstances rather than applying the standard 2-year average.